If you are thinking of buying or selling right now, watch this video because we run through leading indicators proven to predict moves in the UK housing market long before they happen. Hello everybody and welcome back to our property predicting dashboard of leading indicators. In a very interesting month in the UK housing market, we've had some big moves across our leading indicators, counter trend moves. So we're going to unpack those and see exactly what's in store looking forward for the UK housing market. This video is going to take pretty much the same format as previous videos. We're going to explore the Rightmove data versus the land registry data, so the more timely versus the lagging official data. We're going to actually do what we did in the last video, and we're going to dig out 20 years worth of data, but isolated just purely for the month of November. We of course have to unpack the latest mortgage approvals data showing a huge counter trend spike. We're also going to look at the nationwide data and the real, so that's the inflation adjusted house price data, the latest data for Q3 from Nationwide Building Society. Also going to obviously check in as we have done before and see our sentiment index levels, see what they're reading for across the UK, and then we're going to introduce two new leading indicators. One, real M4 growth, which is dropping off a cliff and likely to take house prices with it, and mortgage spreads. But before we do that, let's quickly check in with our coincidental and lagging indicators, that is the UK house price indices. Let's kick off with the Rightmove index. Remember, that's asking prices, which is up month on month 0.7% and still showing annual change as a percentage up 8.7%. If you remember last month, showing for the month of August, it was actually down. So asking prices, as we can see, are still buoyant. Whether that translates into an increase in sold house prices will of course remains to be seen, as we'll get the data from the land registry lagging 2 months later. Next up, let's move into our mortgage lending indexes. That is both Nationwide and Halifax. We can see here Nationwide for the month of September, house prices actually flat month on month, but still up from the previous year, 9.5%. And the Halifax House Price Index showing a slight decline month on month for the month of September. So that's from August to September, but still up again, annual change 9.9% year over year. Last but by no means least, we have the land registry data, which is covering the month of July. We saw a huge month on month move and still plus double figures for the year over year change. Again, the other official statistics are the ONS, or the Office for National Statistics, showing a seasonally adjusted 1.2%. They use the same data, bear in mind. One is non-seasonally adjusted and one is, and of course showing the same year over year change, non-seasonally adjusted. If you think back to video one, where we posed the question, have house prices actually already crashed, but we're waiting for the lagging official data to prove that, we said that there was a 78% chance that this figure was going to come in positive when we analysed it against the more timely index that's Rightmove. Again, we were spot on here. And if you think back to the last video, we analysed prices for August, and so we know what we think is going to happen there. Okay, then back into our dashboard, where I've pulled out the last 20 years worth of data, official sold prices data from the land registry for exactly the month of November. Here we're looking to isolate just 1 month and see what has historically happened during that month for the last 20 years. Hopefully, this will give some insight to anybody possibly looking to buy or looking to sell next month. And unfortunately, it's a mixed bag. Of the last 20 years, 10 have shown a month-on-month decrease and 10 have shown a month-on-month increase. However, if you add up all the decrease months and add up all the increase months, so the months where they've either gone up or down when compared to the previous month, i.e. October, you'll see the skewing is actually ever so slightly to the downside. Right, we're going to move on, and next up is mortgage approvals. I am mindful these videos are quite long, and look guys, I'm not a YouTuber, okay? I have nothing to sell you, right? This is not a business. Skip exactly to where you want in the video. Please don't ignore any of these leading indicators, and I'll come on to why. But I know in YouTube videos they say, hey, stay till the end of the video, etc., etc. At the end of my videos is the end of the video. Okay, by the end of the video, you should have got exactly what you want from this, knowing whether it's a good time to buy, sell, forecast forward, and just generally have a better understanding of the property market. Okay, mortgage approvals then. One absolutely massive move to the upside, which is really, really counter trend. In fact, I can show you how big this move is if we actually just rank them all in order. And we don't really need to start getting into distribution of returns or descriptive statistics. All we've done here is something very, very simple. We've taken the difference, the month-on-month difference, and you can see that in this column here, and then we've ranked them in order from biggest to smallest. And you can see that this month, so the month from August to September, is actually the 5th largest we've seen going back all the way to 2005. So mortgage approvals increasing is very, very bullish for the property market. So is this the pivot, the first little sign of growth potentially coming to a ripping housing market? Or is this actually just people looking to remortgage to lock in much, much lower rates before they think they're going to spike higher? Well, I can tell you, it's actually the former. This data, the official data taken from the Bank of England database, which shows mortgage approvals, does not include remortgages. So yes, whilst the remortgage data is actually showing an increase, I believe, in people trying to beat the inevitable mortgage interest rate hikes, this is not encompassed within this mortgage approvals data. Now, whilst one data point, albeit a very standout data point, does not really make for a trend, however, it's something we have to keep our eye on. Yes, it could be people applying for mortgages who don't have a property, who maybe are renting or living with parents, who are thinking, well, I need to do exactly the same thing as what everyone looking to remortgage is doing. Get a mortgage approval in front of me in writing with a decent rate before those inevitable rate hikes. And actually, why wouldn't you? It's a shot to nothing if you're thinking about purchasing, even just thinking about purchasing within the next 6 months. You may as well go to a bank or building society and get a mortgage approved before rates go much, much higher. Something we could maybe unpack in the next video would be the amount of mortgage cancellations. That would be an interesting metric to see the relationship between the approvals and then the cancellations, or those mortgage approvals that haven't been taken up and underwritten into actual mortgages. Next up then is real wages. As I said in the last video, if you can't afford it, you're going to struggle to buy it. This is the key. This is what really everything comes down to, money in your pocket. But it's important for two reasons. Okay, it adds to the amount of savings that we have, and we're going to come on to Real M4 shortly, another fantastic leading indicator. So it's savings, but it's also leverage. If your wages are going down and you're looking to be lent between 3 and 4.5 times your salary, the amount of money a bank is going to lend to you is also going to be coming down, especially in an inflationary environment where affordability is going to be key, it's going to be paramount in any bank looking at you, analysing your earnings and your outgoings before a mortgage approval is made. Now, we've covered historically real average weekly earnings and how tight it is to the housing market cycles. So we're not going to do that in this video, only to see that the real wages are down off their January 2022 highs, and they don't look as if real wages will be keeping up with inflation anytime soon. However, things could change. And on that point, I want to make a really, really key point here of how we analyze and build biases throughout this dashboard. If the data changes, then so should our biases. This isn't rigid, this is completely flexible. Instead of saying, well, in an October video, you said this, it was that. If the data changes, our biases should too. Next up is real house prices, or house prices adjusted for the RPI index inflation measure. Okay, so it's simply house prices minus RPI inflation. As we said in the last video, we believe this was going to show a negative downward move in real house prices, and we were right. In fact, according to the official Nationwide Building Society data, real house prices have fallen 3 quarters now in a row. We're going to move on now to one of our newest leading indicators, which is M4 growth. This is real M4 growth though. I've simply adjusted it for inflation, CPI inflation, to give us the real inflation adjusted number going all the way back to 1995. And of course, with a lag, that's why it's a leading indicator, this pretty much tells the story of the UK housing market to date. But with one slight caveat, the UK housing market or prices haven't yet caught up with real M4 growth as they did in the 2008 crash. So what is M4 money supply, and why, when it increases, do house prices in percentage terms year over year go up? And why, when we see sharp drop-offs in M4 growth, do we always see house prices correct? M4 money supply, or M4 retail in the UK, is actually just the official name given by the Bank of England for the amount of money that you and I have, but just cash. So this includes money that we have at the bank and physical cash as well, so notes and coins. And it therefore goes a long, long way to explaining these moves in the housing market. We're Brits. We like to invest in property. When we have more money, we invest in property, prices go up. When we have less money, we feel poorer. House prices are reflective of that and actually go down. So I said I was going to show you a graph in which we overlaid year over year house prices, real house prices adjusted for CPI inflation with M4 money growth plotted as well. And here it is. In fact, all we've done here is isolated the last house price crash since 2008 and the subsequent recovery. As you can see, when M4 increases, so do house prices. When M4 decreases, so do house prices. This is one of the reasons why house prices are at a statistical dislocation to M4 growth. Yes, there is this lag, but we can expect house prices to correct as they always have done throughout history. Now this graph probably needs no explanation, but you can see the sharp decrease in M4 leads to house prices falling, the sharp increase increases in house prices, then this long protracted trough also affects house prices in a downward movement, and then we have from around 2012 to around 2017 this long increase in M4, which again coincides with a real year over year increase in house prices. Where it peaks, we see this gradual decline, and of course this rocket, this COVID induced rocket, which saw house prices absolutely fly up in 2021. But we've seen a massive fall in M4 growth since then. Will house prices correct? Well, I think they will. But actually, so do banks. And we're going to come on to that and unpack this with the mortgage spread slightly later on. But we're going to jump over to our sentiment index and see what the reading is there for this month. Here we have the GfK Consumer Confidence Barometer. Now we've ran through this in detail in previous videos. If this is new to you, go back to the old videos and catch yourself up. But what we can see here for this month is the worst ever reading we've had in the history of this index. So what does that mean? Well, I like to pose the question, is this bullish or bearish for property? Well, you'd have to argue bearish. When consumer confidence is at historical lows, does this sound like a good time to possibly make the largest purchase of your lifetime in buying a property? Well, you'd have to argue no. On the whole, generally, the country doesn't think it's a fantastic time to buy anything, you could argue. And actually, they're more concerned about the general economic situation of the country than they were in the previous month. This is the data for September. So with sentiment worsening across the whole country, across all sectors, especially the economic situation, this is likely to feed through into house prices. It's just a matter of when. And so much of the when has been underpinned by supply and demand. Now, for that, we're going to jump over to the RICS data and unpack that for the latest month. Here we are in the latest RICS residential market survey. And remember, we're looking for two things. We're looking for supply and we're looking for demand. But not only that, as we've said in previous videos, you cannot take these in isolation. What we want is a skewing or some kurtosis in the ratio. Now, what I mean by that is, let's just say demand is 10, okay? And let's just say supply is 10. If demand falls and moves down to, say, let's just say 9, but supply also falls down to 9, there has been no movement in that ratio. So what has happened then, according to RICS, in supply and demand? Well, let's start with demand. The aggregate net balance for new buyer inquiries slipped to a reading of negative 39% in August. This is down sharply from the figure of negative 26% beforehand. Okay, that's demand down. What about supply? Well, supply, called here flow of new instructions, remains as much in decline as well. So what they're saying here is that the net balance of minus 15% is actually fallen further from the previous month, which was minus 6%. Now let's quickly do the maths between minus 6% and minus 15% and minus 39% and minus 26%. Aha, we've cracked it. Supply is actually falling slower than demand is. Now, this is just 1 month of data, but it shows that dislocation, that ratio that we're looking for between supply and demand starting to unwind and play through as we thought it would do. The last two things now on our list to cover of our dashboard of leading indicators proven to predict property moves are rates and a 5-year mortgage spread. So what have rates done? Well, we get this data from the Bank of England, and you can see right across the board, as we had in the last month, rates are up month on month for nearly every mortgage product. And I know that weakening affordability or a reduction in affordability is covered through mainstream media and other YouTube channels. What I want to do here is introduce you to something even better than just categorizing mortgage rates, and it's actually mortgage spreads. So what is a mortgage spread? But it's actually very simple. It's simply the difference between the 5-year bond yield and a 5-year fixed rate mortgage. But what it shows us is something much more interesting than just mortgage rates alone, because it shows us risk. This is banks pricing in perceived risk into the housing market. The higher the spread, the more risk there is. The lower the spread, the less risk there is. So what do we see when we look back at this historically? Well, immediately in the middle of the graph, you can see this increase in the spread where 5-year mortgages, the difference between 5-year mortgages and 5-year bond yields was increasing. What happened as a result? The GFC, the 2008 house price crash. We were actually told about this way before it happened. And as the spread increased, house prices fell. Actually, we can go one step further and argue that the spread was telling us the recovery in house prices after the crash was false. Why? Well, spreads remained high, actually increasing further. So were they right? Well, we had a double dip recession and house prices in nominal terms and real terms fell again. And going back to this chart, you can see that indicated in percentage terms and in this chart in real terms, in real house prices. Two last points to note: what was happening with the spread prior to the GFC and what's happening right now, so we can attempt to get out in front of the curve in UK house prices. Well, it's quite clear that this medium-term trend in the spread was downtrending, identifying less risk in the housing market. Well, what did we see? We saw stellar house price growth. In fact, the spread again tells us that the apparent dot-com bubble, the bubble that burst in the tech sector in UK and US equities, wasn't actually going to overspill into the housing market. The spread was telling us otherwise. And what happened? House prices didn't crash. And what about what's happening right now? Well, you can see here the spread has been increasing from about the summer of 2021. That was until last month, the month of September. And why we see this negative reading for this month or the last month, which is the month of September, is we saw some rather peculiar activities within the bond market where the BOE, the Bank of England, had to kind of come in and play backstop. How I've actually calculated this is I've taken the average yield throughout any given period. Here it's shown monthly. So this goes a long way to explain why banks and building societies furiously started withdrawing products from the market, because the bond yield, the UK government bond yield, had risen to a higher amount than what they were charging, the banks and building societies, for mortgages. The spread was negative. And so the question is, why would any lending institution want to earn less than they could from the risk-free bond rate from the UK government? And the answer, of course, is they wouldn't. They pulled products to scramble to reprice them higher. So this downward line, in fact, just indicates 1 month, whereas this trend has been growing since around last year. So if we see this trend line continuing to push higher, rates or the spread is continuing to increase, we are seeing increased risk in the housing market and prices will adjust. The very last thing we're going to look at, and we have to look at it, is the market expectation for inflation. Here we can see the implied inflation forward curve. Now, I quoted this in the last video. Governor Bailey, the governor of the BOE, said, we forecast from this curve. It's a very, very important curve, therefore. Now, as we've said in previous videos, the market doesn't believe inflation will get back down to the BOE's 2% mandate ever. The inflation genie, if you like, is out of the bottle. However, the difference from when we last looked at this curve is the short end, this front end here, is expected to fall before again matching up with where we were and the day of the curve of the previous MPC meeting at around 3.5% to 4%, around 15 years before falling again and then rising 40 years later. So what can we infer then? Well, we can say that inflation is expected. The market expectation of inflation is that it will be around with us for some time soon. It doesn't actually get back down to between 2.5% and 3% for around 2.5 years. So what does all this mean for us? What does this mean for UK property? Well, the reason we keep an eye on this is because it generally will dictate a large amount of the BOE's policy regarding bank rate, i.e. the interest rate. That, of course, is vital to the UK housing market and affordability. The one feeds into the other. So whilst inflation is a quote unquote thing, we're going to be constantly referring back to the implied inflation forward curve as a way of trying to get ahead of any BOE changes to bank rate. That's the end of this video. Thank you so much for watching. I'll see you in the next one. Guys, just quickly, I have started a property signals newsletter. It should be exactly as it sounds. It is to keep you abreast of large moves, so big 3 or 4 standard deviation moves within one or more of these leading indicators. The reason for that is I do like to publish these videos when I have a complete data set. The dates of each data set being released obviously varies, and that can mean it's between 3 and 5 weeks between a video. It is on an FCFS, first come, first served basis. I'm going to use something like a MailChimp, whichever is a free email provider, to ping this out to anyone that's interested. I think I can get up to 500 people for free. I'm not going to use a paid account. So as I say, it's a first come, first served basis. Also on this, I've written a bot. It's actually more of a scraper, but it's a bot that goes out and searches for the best mortgage data. We're now seeing mortgage data changing, not monthly or weekly. It can actually be daily. The reason I did this, I was searching for some live mortgage data in the market using a price comparison website. I then went to another one because, of course, I need 3 data sources and found the same exact mortgage with the same lender for slightly more expensive. So the first comparison site I went to, it was cheaper. I then, of course, to get 3, went to another price comparison website and found it again cheaper, not with the same lender. The point I'm making is lending rates are varying massively. So if you're interested in finding out the latest best mortgage data, then sign up for that. Again, first come, first served basis. I can only send this out to a maximum of around 500 people.